Okay, we're going to get started today by looking at the calendar. Okay, we have just gone through Santa's rally in the stock market. Traditionally, Santa's rally is the day, 5 days of Christmas and maybe 2 days before New Year's and maybe 2 days after. Um, so seasonality wise, we went up 1.5% this past week. Actually, for the last 2 weeks of December, for the past 40 years, we've gone up 80% of the time. So there's a pretty good historical context, seasonality wise, that we have a Santa rally. But you can see by all means, if we look at our stochastics for our S&P 500, we are overbought. So we are pretty much overbought right now. Um, not necessarily at the top of our rating range, but um, I have caution, yellow caution in January because we are overbought right now. A lot of times we pull back. Um, we do have earnings starting up at the end of January, so that usually allows the stock market to go up when we have earnings again. The banks will be reporting towards the end of January. February has traditionally been like a sour month, a pretty bad month. If we look at our seasonality, it's one of the worst. It's 0.29% advance that month. And that's probably because the weather isn't that great in the Northeast where most trading is happening. But we do have a seasonality, a very good seasonality for January and December. So, um, because primarily because we do have earnings coming out in January, and that does help stocks in some way. So we also have uh, New Year's coming out. That's the first, and we also have Martin Luther King Jr. Day. So we have some holidays. Usually, the stock market rallies around major holidays. So let's see if we do rally before the end of the year. Um, but I do expect some kind of pullback the second and third weeks of January. All right, let's look at our earnings reports coming out. You can see that for this week, for last week, and this week, we basically had maybe one small company report, but that's it. But we look, we're going to start having banks starting to report coming come the end of January, January 16th and on. We have Citibank, we have BNY, Morgan Stanley, PNC. So all the banks usually report first. So just when you thought the earnings season was over, we're starting all over again. But we basically have nothing, no catalyst really regarding earnings reports for the stock market in the next 2 weeks or in the next week. All right, so let's look at the S&P is actually up 1.5% since last week. So the Santa rally did come around. So our near-term catalyst of Christmas and New Year's, so far Christmas has been good for the stock market. We are overbought, so don't be surprised if we pull back some. Um, the 10-year is down 0.7%. So if we look at our um, 10-year, where is the 10-year? Right here. You can see that we've been trending downward since June. So when we look at our market movers, we're going to keep in mind that we are going down in the 10-year yield. Okay, so let's look at We do have 60% of the S&P above the 50-day moving average, 60% above the 200-day moving average, which is pretty positive for momentum. Um, right now, that's kind of between 30 and 70%. That's kind of a neutral market. It's mixed. It's not necessarily a total bull market or a total bear market. It's leaning towards a bull market. We have we don't have earnings reports after this week, so we have to wait for a couple weeks to get earnings reports. Um, let's look at the S&P 500 stochastics. You can see we're overbought right now, but we are above all of the moving averages, which is very positive for continuation of the stock market going up. All right, and if we look at our major variables of the stock market, you can see that crude oil has been pretty constant from last week, unchanged. We have a combination of a slowing economy and a lot of output by countries for oil. So the price of oil continues to stay low. Let me see. Inflation is cooling off just a little bit. It's 2.7% this week. It was 3.0 last week. Um, and the US dollar is unchanged also. Yeah, gold is actually up 2%. Gold and silver have been rallying, and everyone was wondering why. Because if we look at our dollar index, if the dollar kept going down, that would be a good reason for gold and silver to go up. Because usually gold and silver are priced in commodities, priced in dollars. So whenever the DXY or the dollar index goes down, usually the price of most commodities go up. But we've been in a sideways pattern for at least since May, 6 months. So it wasn't because of the US dollar that the gold is rallying. It must be something else. Maybe central banks buying. For silver, we should start keeping track of that. China is actually limiting the supply of silver on the market starting January 1st or so. So silver has been exponentially like doubled this year, and it might go up even more because China actually controls 60 or 70% of the silver market. And because of that, silver prices um, go up whenever they constrict the supply of silver in the world. Also, silver is used as um, in industrial use. So as the price of silver goes up, that it makes it harder for companies to do business. Like for instance, Tesla's CEO Elon Musk was complaining about silver and how important it is to a lot of things that he does for his businesses. Right. So fear and greed index, we're at greed right now. Um, that's usually an indication that take some profits off the table or don't buy. We have a lot of investor sentiment as bullish. For the past 4 weeks, we've had bullish and individual investor sentiment. So we are overbought right now, so it's pretty dangerous to buy when everyone else is buying. Usually, the Santa rally doesn't last all of January, so we are overbought right now. So it's very you have to be very cautious right now for putting in new positions. The VIX, we are 1 point lower than we were last week. We are at 13. 13 is people are not concerned about the stock market going down. Um, and so it's basically a bull market right now. And that could change, when we get towards February. And that's one of the worst months of the year. Let's look where we are in our emotional graph. We are at greed right now. And what are some things that could cause the stock market to derail and go into fear or capitulation? Hmm. Right now, the biggest things that could derail a rally, maybe earnings reports coming out bad towards the end of January, and indications that the US economy is slowing down. But right now, the economy is piping hot. It's doing really good. Um, and we don't have real terror threats right now. So it seems like things are pretty calm. So we'll keep an eye on our emotional graph. Um, let's look at our worst to first from this is like the last worst to first we'll have for this year. You can see the communication and IT sectors performed the best this year, and they were the best last year. That's probably because these sectors have the highest growth and most consistent growth companies in the S&P 500. What other companies did well? We had financials doing well, and we had industrials doing well. We had a bill that was passed that helped out a lot of the industrial companies. And the worst performing sector, real estate. Why would real estate be down? Probably because of interest rates. If interest rates were lower, we'd have a better real estate market for sure. Energy is down because of the price of oil, most likely. Oil has been a very low price, and most energy companies are at the mercy of the prices of the underlying commodity. So even if you have the best run company like ExxonMobil or Chevron, you still are at the mercy of the price of oil. And if the price of oil is low, you don't make as much. All right, so okay, so our theory from the beginning of the year, our thesis, interest rates are going down, and they did go down during the year. Investors will be reaching for stability amid chaos. Investors preparing for a slowdown in the economy, possibly a recession. Um, People will be going towards utilities, healthcare, and consumer staples. Well, actually, what happened this year, people did go towards utilities, but for a different reason. They went for the AI infrastructure play. So utilities did do well. They did 13%, but healthcare basically, although it was the best performer in the last month, it has lagged the whole year, and it's only up 13% now. But consumer staples were a total dog, and they were only up 2%. So it was basically a risk on year for the stock market. It's just basically a repeat of last year. So we got to think of what we're going to do for next year. And um, we're going to probably predict what sectors will be doing good and bad. And we'll see if we're right. Um, all right. So let's look at some of our most undervalued sectors right now compared to history. Right now, the real estate sector is like 1/10 the price it usually trades at in a 30-year basis. That is amazing. Although I wouldn't want to invest in real estate right now. It's not my specialty. I'm more of a growth investor. So I'd much rather invest in IT and communication services, maybe some healthcare. Those are my favorite sectors. All right, let's look at some of the stocks going up and down today. Okay, you can see that Freeport McMoran is up a lot today. They actually are a miner. They make gold and copper, which are both on fire right now, and they produce some silver too. So that is a very popular trade now, silver, gold. And that could be why they're going up. And we have the theme for today is, hmm, I don't have a theme. Let's look at the ones going down the most today. We have Moderna. They are down like 80% this past year. They do vaccines, and the Trump administration has been giving them a hard time. We have Palantir. They're an AI darling, and they've gone up maybe 100% this year. So they're giving back a little bit. And I guess the theme for this top decliners is most of these have ran up a lot this year. Like we have Robinhood, it's up like 100% this year. It's giving back a little bit. We have Palantir, same thing. We have, I don't know why the Carnival Cruise Lines and Norwegian Cruise Lines are down. Okay, well, all right. The Brown Forman, they sell spirits and alcohol, and they're down 2.6%. They're probably one of the worst performing stocks in the S&P 500 this year. Not sure why. Maybe because people have different tastes and maybe they're going away from their brand of alcohol. Let's look at, that was a good exercise. Now, we have on our 10-year, we can see we're going down. So we expect, we're going to look at our cheat sheet. Yield's going down. Positive for small caps, high yielding stocks. So we expect high yielding stocks to do well, home builders to do well. Negative for any company that the financial sector, large techs. Let's see if that happened. Sectors. We see that okay, yields are going down. You would think that the S&P telecom sector would go up because there'd be a higher demand for high yielding investments. So biotech is down. That's surprising because biotech should be going up if the yield, the cost of borrowing money goes down. So let's see. This one's going down up the most. Gold. Okay, gold and silver is on fire right now. So materials, okay, that goes along with the gold and silver mania. And semiconductors. And why are they up today? Well, maybe it's because NVIDIA had an article that they bought a startup called Grok, GROQ, and that means a lot of these same stocks in the same sector would go up with that. So same with this semiconductor ETF. Now, home builders, this is like total opposite what we think. The yields are going down. That would help the home builders. That makes sense. So as the yields to the 10-year goes down, the affordability of buying a house goes up. So there's more houses sold. That's why this sector is up. Same with this. Let me see. Okay. And that's why real estate is up. Okay. That was a good exercise. Construction is kind of break even. Let's look at, that was a good exercise. Let's look at Dan Now's picks. This is the last time we're reviewing his picks for the year. Cisco up 32%. KBWB, the large cap bank ETF, 32%. Can you believe that? Two awesome picks. However, his other picks are pretty subpar. ADTN only up 5%. The IJJ, the mid cap ETF, It's only up 7%. In cash, that performed like the worst. It's only up, maybe if you put your money in cash, it's only up 3% this year, which is probably the worst. But KBWB and Cisco are darlings. Now, next time, we'll have Dan's picks for next year, and then we'll see. I'm going to start investing in the ones he recommends next time. Okay, we'll see. Okay, let's look at his reasons why he picked Cisco and KBWB. Cisco networking, the data being generated from AI. Okay. And KBWB, this is the banking ETF, large bank ETF. Deregulation, net interest margin grows, and active capital market. That ended up being true. Also, that's going to be happening next year too. So I think that KBWB is also going to be probably a good sector for next year. Okay, let's look at some charts I thought were interesting. Look at Amazon. Amazon is in a basing pattern. Look at this. It's been going in the same pattern for it's almost a year, almost over a year now. So Luis Yamana said, the longer the base, the higher in space. This is one of the worst performing Mag 7 stocks this year. It's actually like a 0% return. So, and it's oversold. Look at that. Um, it's totally oversold. No one wants it right now. And it's at the bottom end of its trading range. So it's like a perfect time to start dollar costing into it if you're interested in it. I'm going to go over Amazon a little bit later. Okay, here's some stock screens, a stock screen we did for this week. I picked out some of my um, just eyeing it up, some of the interesting stocks. First one is JP Morgan. This is one of the best performing stocks so far this year in the banking world. It's it's the best run bank, and it's the largest bank in the world, I think. And they have a size of scale, so I've high conviction in that. But they're pretty overvalued right now. They're like 1.8 peg ratio. That's like almost 2 times overvalued. But they're consistently growing though. And we've been talking about Micron for like months now. It's around one third the value it should be. And Schwab, this is it's kind of a large bank. They have brokerage too, but they're a little bit undervalued. And see, here's a stock right here, Merck. We were talking about Merck back when it was trading at 80 some dollars a share, and it was zero point 0.7, zero point 0.8 peg ratio. But now look at this, it's trading at 1.9, 1.3. So Merck is a company that has a major stock called Keytruda. It's one of the best-selling drugs in the world, and it's coming off patent pretty soon. And they're trying to replenish their portfolio of drugs. And so far, they're doing a pretty good job. So um, I diversified just a little bit and bought some Merck just to get some drug in my portfolio. Um, let's look at some more. TD Toronto Dominion Bank. It looks like they're like 25% undervalued based on the PEG ratio. Newmont Corporation, we looked at this 2 weeks ago. It was 90s. Now it's at $106 a share. They mine gold. And DoorDash. They're around 20% undervalued, but they're not as reliable right now because they have Uber as a competition. FCX, look at this. We were looking at FCX way back whenever it was a peg ratio of less than one. And look right now, it's um, one of the stocks that's kind of rallying because of the price of silver and gold. And we also have another gold one here. It's called Kincross Gold. It's like half undervalued. Maybe we can look at that next time. All right, that's a good exercise. Okay, here's an interesting article that came out. 26 stocks, US stocks to watch in 2026, according to UBS. I thought it'd be interesting to go through some of their picks that they've chosen. A lot of them are smaller cap, and I'm going to consider some of these out of scope for this talk right now, but I'll highlight some of the ones that I thought were interesting. Okay, they like As- Acadia Pharmaceuticals um, and United Healthcare Group. We went over United Health before. There's a lot of problems with the way this company's been run. A lot of the managed care providers are um, hitting multi-year lows right now, and United Health has kind of bounced a little bit. I can't get my mind into that right now, and um, but what I did do is I highlighted one of their couple of their technology picks. So they like Amazon. They think it's a coiled spring due to investments in AI infrastructure, Amazon Leo, sports licensing, and e-commerce delivery. Just think of the moat that they have. How many other companies are able to deliver next day and have that network around the world that they can basically fulfill anything that you want to buy overnight, and that's for free. That is really that is a moat that's really hard to break. So they like Amazon. We'll go over that. They like ANET, Arista Networks, Cisco, and CIS, and they like Snowflake and Texas Instruments. Okay, I thought we'd go over Amazon. So as one of the stocks we're going to look at. Um, Another one of the financials that they like is Capital One Financial Group. I don't know if you remember this, but we went over this a couple months ago whenever they bought Discover. Um, Basically, credit cards are one of my biggest part of my portfolio. I have Visa and MasterCard going back to when they were IPOing. So I really know the industry pretty good. The great thing about the credit card industry is they're like a toll collector. Um, and if you do a transaction in their network, they take a fraction of every purchase price. So COF just got their own network, Discover, and it's an independent network. So they not only have Visa, MasterCard branded credit cards, but they also have the Discover card, and they should be able to improve their efficiencies. We're gonna look at Capital One a little bit later. Other stocks that they like from financials is S&P Global, Xterra, MHL, TPG. These are smaller companies. Marsh McLennan Companies, MMC. So I like larger companies, so I'm going to stay away from the smaller ones. Other stocks they like in the industrials and utilities, Deere, DCO, Xterra, GM, and JCI. They make Johnson Controls. They make air conditioning units for companies. Woodward International and U.S. Alliant Energy Corp, LNT, Next Power, and let's look at the consumer materials. They like Decker. They do um, Decker's Outdoor Company. They have like Lowe's, Pepsi, Cisco, and Lind PLC. They're a gas company, industrial gas company. Jim Cramer likes this company. And all right, that's probably enough. That's all we need. I'm going to go over Capital One and Amazon because they're ones that I own, and I thought it'd be interesting to go over them every now and then. If we look at Amazon's chart, I mentioned earlier it's kind of baselining here, and it's like at a perfect time to buy it because it's out of favor and it's oversold. Let's look at the fundamentals for Amazon. They're if we look at their outlook, they're growing at like between 20, they're growing 26%. No, they're going 20% from this year to next year, but from 26 to 27, they're growing at 26%. So I'm using 26, they're growing, their PE is 28. So the PEG ratio is 1.21, which it's very close to fair value. It usually trades for a higher premium than this, so it's kind of on sale right now. You can see their profit margins are 11, return on equity is 20. That's exactly what we're looking for. And return on equity is 24. That's double what we're looking for. And they have some debt. They have like 60 billion in debt, but out of a 2 trillion, 2.5 trillion market cap, that's nothing. Um, and you can see they're profitable. They have um, operating cash flow is 130 billion, which is pretty good. Let's look at what CFRA says about Amazon. They have a strong buy, price target of 303. So I like to look at this little saying here. Our opinion is strong buy. Amazon remains a compelling and durable multi-year profit and free cash flow story. In e-commerce, the company seems to be gaining share, especially everyday essentials, while rapidly reducing its cost to serve. In AWS, momentum is finally here with growth accelerating to 20% in Q3 2025. We are seeing the potential for further acceleration in AWS, and they have an ad business. The company continues to have strong momentum in both e-commerce and business and rapidly growing video business. And finally, we see upside should Amazon find success with some of its other bets. They have a Cupitor, Telecom, Zoox, autonomous vehicles, and Alexa Plus. So they beat expectations. I think they're going to be growing like 13% to 20%. And I've held this for like 10 years. So it's great to see that it's still growing, even though they're a huge company. CFRA thinks that they're undervalued by 5%, which is a good sign that they're very close to fair valued. You can see that Amazon lost money in 2022, but in general, they have a straight line up for their earnings. That's what you want in a growth stock. Hmm. Let's look at what Morningstar says. Sorry, they have a fair value estimate, 260, which is 10% undervalued. So they agree that it's undervalued. They think AWS acceleration is going to help them with their results. Okay, hold on for 1 second. Okay, I'm back. I had to get some water. Um, All right, so let's look at Capital One next. Capital One has a PE of forward PE of 11, and according to Yahoo Finance, a PEG ratio of 0.67, which is 30% undervalued. So let's look at the growth rate. From this year to the next year, they're growing at 21%. From 26 to 27, they're growing at 33%. So we're going to use 33%. We're close to 26. If they're growing at 33%, the PE ratio is 11. That means they're 33, they're one third the price they should be. That's pretty good. So, so Yahoo Finance thinks they're 30% undervalued. I think they're like 66% undervalued. But their return equity isn't that great. That's one. I expected for a credit card company over time, this is probably going to go up a lot. Right now, it's one. The profit margin is half of what we're looking for. And they have more cash. Wait, see. Let's look at their cash position. They have more cash than debt. So that means that they don't have a debt issue. So even though they made a recent transaction to buy Discover Card, so it seems like they're growing at 33%, which is pretty amazing. Um, Over time, their margins will get better with this Discover acquisition. So these numbers will probably get better over time. So we have to give it patience. But they are running their own network now. They are out of just Visa and MasterCard for their credit card operations. So that'll help them a lot. Let's look at what Morningstar said. Morningstar said they are 18% overvalued. They say Capital One's credit costs are improving, but integrating Discover will be the focus for 2025. So let's see how they integrate the Discover card and see if they get more efficient. I'm thinking these numbers will go up over time to be closer to Visa and MasterCard. MasterCard has a return on equity of like 130 or something. And Visa actually also has a very similar return on equity. So we'll see if this Discover card helps them. Let's look at Capital One, the CFRA, what they say about it. They have it as a buy with the price target higher than it is now. I like to read this little investment rationale. Our 4 stars buy opinion reflects COF's Discover acquisition as an exciting long-term growth driver. Networks are difficult to build organically, and Discover provides expense and revenue synergies while helping them capture vertical integration economies and generate revenue without credit risk. COF's analytics can help merchants through lower trade fraud costs and increased sales. Expanding higher end customer presence should reduce earnings volatility and drive stock re-rating higher. Okay. So if we look at the numbers for Capital One, they're totally not even close to Visa and MasterCard's valuations. They're like trading at 1/10 of the valuations that Visa and MasterCard are at right now. Not 1/10, maybe at least a half. CFRA thinks they're worth 197, which they're overvalued by 20%. So that's interesting. So they have a undervalued for Morningstar and overvalued for CFRA. So to keep that in mind. Let's look at their earnings over time. Let's see how consistent this is. It's pretty inconsistent. You can see that we have $7 a share, 6, 3, 11, 11, 5, 26, 17. So we don't have like a true growth stock here where they're growing 20%, 10 or 20% a year regularly. But we could have the makings of a new Visa or MasterCard type situation where they might have more consistent earnings going forward. So I don't know. We'll see what happens there. This is a good time to review the sector performance compared to last year because over time you can see that different sectors outperform every year. And as a part of investing, you have to make sure that you try to be diversified in what you buy so that maybe if some years the sector you're in doesn't perform well, maybe another year it does. That's part of being diversified. So, so you can see this is like this year. Um, some of the worst performing sectors, you see energy, real estate, but the ones doing the best are telecoms. But you look at last year, we had telecoms up, or telecommunications up 40%. That's like Google, Facebook, those type of companies. And we have, so you can see this being diversified in your investments allows you to um, have more consistent earnings over time. So that's good. That's a little good thing to do. All right. So that's basically all I had for today. I hope you enjoyed the talk and I hope you have a great new year and I'll see you next year.